Welcome to the Modern CPA Success Show, where we're 100% focused on helping accounting firms achieve success. If you're an accounting firm owner who wants to learn how to provide virtual CFO services, then this podcast is for you.
Hello, and welcome to today's podcast. Excited for today's guest. So once again, it's Adam Hale from Summit and Jamie from Summit, but we're joined by Dan Kaelus, who has a pretty busy life, it sounds like. So just like a lot of our guests, he's a podcast host. So he hosts a podcast called Small Biz Matters. So he's doing that. And then he has the CEO of two companies, upgraded marketing systems and fully fundable. So we brought Dan on for a couple reasons. A lot of our clients come to us and they're like, we need funding. And we kind of give them the same old answer. Okay, who are you banking with already? Let's go talk to the big banks and let's talk to the ones you have relationships with. And oftentimes that well is pretty dry, especially for clients that don't have a lot of capital. So we got connected with Dan because obviously he has some alternative lending options for our clients. So before we go down that road, Dan, you want to give us a little bit of backstory on you and kind of the companies and your busy life?
Sure, thanks. Yeah, good to hang with you guys here. I never thought that I would actually be in financial services necessarily, but that's really been my entire career after college. I got into the investment world in my early 20s, and that was kind of a weird time to do it because it was right around 9/11, just incidentally my birthday as well. And when you're a young 20-something-year-old and you're trying to talk to sophisticated individuals, high net worth, affluent about money, whether you're a CPA, whether you're a CFO, an investment person, it's a big challenge. And so that was a little bit short-lived. Got into the mortgage business, so I kind of got to see lending from a consumer standpoint through the era of the Big Short era. I assume a lot of people have seen that movie and kind of saw the chaos of that, and got out of that in 2008. And then kind of morphed into commercial lending to a different degree, which we'll talk a bit about today. And so I started off doing business credit, working. I wanted to get into real estate investing, and I wanted to flip houses, and I kind of caught the craze of that back in the day. And I thought, if I'm gonna do some sort of funding, and I want to get into real estate, why don't I offer funding to real estate investors? Now I can insert myself in that world. And I think there's a pretty good lesson there that, you can kind of cater your services or your specialties to anything that you really want to learn. I mean, if you're CPA, obviously some of the people watching or listening have a niche in certain industries. I know obviously you guys as a firm have a couple different niches, and it makes sense to do that. So we learned a lot about that. And somewhere along the way, I decided that I wanted to learn how to do marketing and direct response marketing, digital marketing, so that I could not have to be dependent on cold calling or referrals for generating business. And so all of us that are listening here for the most part, or talking, you guys, the CPAs that are on here, are all B2B really. So, having to do that and get in touch with decision makers and targeting, it's something that is a lot of B2B companies that work with smaller businesses don't really do a lot of advertising. It becomes, you have a referral-based business, and that's great. And sometimes that's all you can kind of handle. But, we learned that just so we can kind of scale that up. And so some of you are in that position, some of you are not. But so that's why I have this kind of combined, background of financial services and commercial lending, and have seen a lot of different, the 2008 economic collapse and all the issues that go with that. Now what we've run up against with, the coronavirus era, and, who knows how long that's going to pan out. So it's relevant now. It may not be relevant later. But at the end of the day, there's always going to be roadblocks. There's always going to be unforeseen things that we as B2B professionals run into for our clients. And I kind of look at it like I have the ability to play financial offense for the clients and help them really either get the capital they need to keep growing where they can't get it from other sources. And then I can help them optimize things they're doing to generate revenue. And you guys are the experts at probably some of that too, but a lot of financial defense. And, everybody knows that championship teams require both. And so, to really help them find hidden money, either direction. So that's kind of been what I really end up doing. And then we started the podcast because we wanted to just be able to reach out and give back to the small business community at large in America. And when I say small business, and again, everybody targets different companies, like 10 million a year in revenue or less, but We do interview people on our podcast that are bigger than that because we want to give advice to the small businesses that are trying to cross that threshold of $1 million per year and then 10 million per year. And so we use that as a way to just really network and bring in really great experts and contribute other content. So yeah, we're keeping busy, and we got a few different avenues to help the SMB market.
Yeah, it doesn't sound like you have much going on, man. What do you do with all your spare time?
Walk my dog a couple times a day. And
yeah, I mean, it's an interesting path you took. I mean, it's funny how kind of sales and finance have an, find themselves kind of intertwining and benefiting one another. I mean, even whenever you were doing the mortgage stuff, I know that's pretty heavily marketing focused as well. So, just as an industry, so I can kind of see where those synergies play. And it definitely does sound like, you can offer quite a suite to a small business. Just to kind of go into fully fundable just a little bit, because we do run into that a lot. As VCFOs and most of the people listening to this are either working hand in hand with clients or are going to start with that. We always talk about banking relationships, and having those relationships are really, really important. So whenever we work with a client, one of the first questions we ask is, what bank are you with and who's your banker? And surprisingly, even some very large small businesses, the 10 to $20 million size, they'll come back and they'll say, well, we work with XYZ bank, but I don't really have anybody, because they're more loyal for whatever reason to the bank than the banker, which is a little bit different than Summit's approach. For us, we're a little less concerned about the bank because we assume for the most part these days they're kind of apples to apples. We're more focused on finding a lending relationship with a person. So here at Summit, we'll just chase people. So whenever they hop from bank to bank, then we'll move with them, because it takes a long time to build that relationship, that trust, that understanding, knowing that you have somebody kind of inside going to bat for you. I think it's become very, that's come to surface a lot through all this COVID stuff. I mean, the clients that we don't have banking relationships with, really were kind of put to the back burner and pretty upset and wanting to move banks now and do those kind of things. So the problem though with that is that some of the clients, traditional lending and everything we just talked about is fantastic, but it hits a cap. It hits a ceiling. Sometimes, as business owners, we got to roll the dice on things like even what you were talking about, like on the marketing side, where we need to double down on some marketing expenses. We need to do a few things, and maybe we don't have the capital to do that. So talk to us a little bit about, kind of who that ideal customer is. I mean, I've got quite a few, obviously, that we've been talking about, between companies, but kind of build that profile for us. Who's coming to talk to you, that kind of thing.
Yeah, and let me back up just a little bit on that, because you're to the topic of banking relationships, and I think to a large degree that whole era of having this relationship with your banker is sort of gone, at least the way that it used to be, maybe prior to the new millennium. I mean, like, I'm not going to mention names of banks, but the mega banks, like there's a lot of turnover there, and it's like, because if you have a relationship with a business banker, or even like one of these private bankers at one of these mega banks, that doesn't necessarily mean that they have all this authority to do certain things for you, because they still have to run it up the chain of command. There's a lot of red tape. If you're going to have a primary banking relationship, that you really, really want to have that subjective look at what you're doing, regardless of your size. The traditional local banks or regional banks sometimes can be better for that. And again, there's pros and cons to working with a mega bank versus that. But yeah, at the end of the day, you look at the small business community at large, and you see some statistics that are startling. Like, the average small business has only 27 days worth of cash on hand. I know that's something that you guys work really hard at, and probably a lot of your CPA associated companies and clients and partners also do, to really put an emphasis on cash reserves as much as possible. But that's the reality, is that when you run out of cash, you run out of oxygen as a business. And I don't care if you're a $500,000 a year business or 20 million a year, the same things can apply depending on what your profit margins are. So I think that, here's an example, right? You asked for the kind of the profile of the company. It really depends on the industry. It depends on a lot of different things. I had a client for funding back in December who's an e-commerce business, and they're doing about $36 million a year. So that's not really a small business, it's a medium-sized business, but they were treated like a small business that was very high risk, because their e-commerce. They did house some of their own inventory, but inventory isn't really always viewed by banks as significant collateral because it's fleeting. It kind of goes away. And I'll get into kind of the 3 C's of lending, one of which is collateral. But they were tapped out. I mean, this is a company doing $3 million a month in revenue, 6-year-old company, high growth, pretty great cash flow. They just had their cash tied up in other things. They needed to buy $500,000 of inventory before the end of the year. And they were tapped at $250,000 on a line of credit. And they had a relationship with this bank. And so sometimes when you think you have those things, you really don't. Now, if somebody comes to us and, what does alternative bank lending really mean? To me and to a lot of the more sophisticated people in the industry, it just means basically non-banking. So you have these different tiers. And like I would say retail banks form that first traditional conventional tier where I would always tell somebody that comes to me to go to them too. I would say, I'm not going to try to get you some funding if you haven't already gone to wherever you bank at, Wells Fargo, Bank of America, First Bank of Tampa, for whatever. It doesn't really matter. Because I can't compete with them on rate and terms. And if I'm going to be serving them properly and have a fiduciary responsibility to give them the right thing, then I'm not going to be able to get that to them. These banks have different access to capital through the Federal Reserve, through different, just different ways that they can fractionalize banking. We're not going to get into that. You guys kind of all know what that is, but they have access to capital and they can lend it out cheaper than anybody else and they have the best terms. So it's always go there first. And if you can't get it from there, then we'll be here for you. And what that really means is, and this applies to whether you're a mortgage lender for consumers or business, which there are very different, but the things that are the same is that it's the 3 C's. It's cash flow, credit, and collateral. And so cash flow, obviously meaning that the person lending the money, the institution lending the money, can see that there's enough cash flow coming in on a regular basis historically to cover the debt service payments. They're not going to default. That's pretty simple, right? And that's usually the one thing that every business can go off of, because if you get down to credit, credit is personal and business. Now, I've worked with lots of businesses ranging from a few $100,000 in revenue to that $36-40 million. And I don't know how much you guys look at this or your CPA firms that are listening really look at business credit. Most businesses in that entire range don't really do a whole lot to build their business credit profile. And it's not that you could have this amazing business credit profile with, say, Dun & Bradstreet or Paydex or these other credit bureaus, and then be able to just get a bunch of money without any kind of personal guarantee. That's not really that much of a reality. But what happens is if you have really strong credit and you have a lot of trade lines and you can demonstrate that your business itself is responsible in that way, then it gives you better rates and better terms. So it usually just defaults to personal credit. Well, again, If you're a small business owner, a lot of times again, this is stuff that you guys are all going to be familiar with. All your CPA people are going to be familiar with. There's a lot of commingling of personal and business funds. Not in a way that's kind of like we're trying to pull something over. Obviously, if they're doing something like that, that's a whole other issue. But there's no differentiation between personal and business, and the credit cards they're using, the bank accounts. It could be a real mess. I'm sure that's a lot of the value that you guys all provide. And so their personal credit gets messed up sometimes. So if you don't have at least a 680, ideally 700 plus personal credit score, then you're viewed as a subprime candidate. And so your options are limited. Retail banks are going to be less likely to look at you. And frankly, the reason why that e-commerce company was having problems, I didn't even mention this, is mostly because of the industry it's in. It's because they don't really understand digital-based businesses. They're used to dealing with tangible, brick and mortar or manufacturing or whatever. And a little psychology principle, and it goes into marketing as well, is that the confused mind always says no. It's a preservation mechanism. If you don't understand what's going on, then you don't agree to something, right? Now, a lot of people don't follow that and they get themselves into trouble, but that's how the brain is supposed to work. And so the banking mind goes that way too. And so they're really just looking for reasons to say no. And you got to think also, right? What's the motivation of a banker that works for a retail bank or a big bank? And, there's a lot of great things that can come out of it. I don't want to badmouth them, but I'm just looking at it as objectively as I can. There's a reason why they say, working bankers hours and doing this kind of thing. They really just want to not do something to screw up their job, really. They're not going to go too far out on a limb and risk that. then when you get outside of the scope of retail banking, you can get into where you're kind of working with more like investor groups, private equity type, fintech companies, and the like. But let me finish the 3 C's. So credit's there, and then collateral. And most of the businesses that we talk to don't really have hard collateral. So what's the best kind of collateral? Real estate, right? Because if they can set it up so that there's recourse if you fail on your loan, they can repossess the real estate, whether it's a commercial piece of real estate. And most small businesses don't own the real estate, they lease, so they don't really have that in most cases. Sometimes they'll go and they'll do a line of credit against their personal residence. Well, that's obviously a very, very risky thing to do, but they do it all the time. And again, you guys may see that when you're looking over people's financials. I wouldn't recommend it unless absolutely necessary. So usually what's left is cash flow. So then the retail banks are going to say, no, because of your credit's not great. No, because you don't have substantial collateral. No, because the loan size isn't big enough to make it worth our while. Or no, because we just don't like your industry or we don't understand it. So there are a lot of opportunities to go outside of that realm, but then realizing that as a business that needs the capital, as a professional who is helping a business from a financial standpoint, CPAs are often in most surveys ranked by business owners as kind of the number one go-to professional in their, out of their attorney, their CPA, their banker, their this, their that, even their peers, they go to the CPA first. And so there's a lot of responsibility with being asked, what do I do in this situation? And so, you're talking about higher risk loans. And so, whereas a commercial real estate loan would be maybe in the low single digits to high single digits interest rate wise, you're talking about loans that are spread out over, 10 plus years, or even SBA loans. That's a form of a secured loan in that it's secured by an insurance policy by the SBA itself. So it's not secured against collateral necessarily, but you're talking about 6%. Once you get outside of that realm, there's really no such thing as single digit interest rates. And so this is another mindset thing. And I think this would be good for CPAs to know, as well as the small businesses themselves, is that not to necessarily be afraid of that either, because to think of debt as a consumer is to say, well, if I'm borrowing money to buy a house or buy a car, I certainly don't want to pay double digits because I don't have an opportunity to make money on my money. But in business, it's about, leverage. And that's kind of what a free enterprise society is very debt heavy and debt involved. And if you're responsible with it, then you're borrowing money at 10%, gosh, even 20, 30% in some cases. But if you're doubling or tripling the money that what you're using it for, then it's just an arbitrage play. So anyway, I don't want to.
Yeah. So I mean, kind of going in that, obviously, whenever I was asking, what's the profile look like? So it's somebody that's already been kind of turned down by their bank, because we know this is going to be non-traditional lending, which means the interest rate's going to be higher. So what are some of those things that you've seen people, borrowing for to kind of double down and get that ROI on their money? Because like you said, if it's real estate or it's a hard asset, most people probably, that's not the first reason why they come to you, unless they have some other issues like the credit or the bank just doesn't want to deal with you, kind of a thing. So what are some unique things that, as the CFO, I'm talking to my client and they're like, hey, I just don't have the capital to do this. What should I do to, what are the things that I might want to come to you for?
Yeah, that's a great question. And I break that down into kind of two different categories. You have emergencies and then you have opportunities. The emergencies are obvious. We don't need to go into that because you're asking about a growth, but if you can't make payroll and you don't have a month to wait for an SBA loan or something, and you want to keep your company alive and you want to keep your goodwill, then sometimes you need to do that. And you can't get an immediate ROI on that. But as far as other things, if you were to look at the top uses, it's going to be what you would expect it to be. Marketing and advertising, staffing, and I don't just mean the payroll example of covering an emergency, but like bringing on somebody and having the money in the bank to pay them, any types of expansion, equipment, depending on what kind of business it is. Not all of them have that, but, and there's, and then within equipment, there's specific equipment financing and leasing, and that's a whole other conversation. But if you're just talking about working capital in general, a lot of times, let me just say this too, in the alternative lending space where the money is more expensive, you wouldn't necessarily just take a loan out just to have the cash on hand. You would really take it out for something that you knew specifically. If you really had really great credit, or you had really great collateral, and you could go to your retail bank, maybe you get a line of credit or you get a loan, it's low interest, and you can sit on it. But sometimes these other programs, the clock's ticking right away, and you may even have to pay back on a daily or weekly basis instead of monthly, and you may have only 6, 12, 18 months to pay it back. So the amortization is a lot shorter, the cash flow is then tighter. But again, if you're, and we do a good degree of marketing, and you guys work with marketing agencies and stuff, if the business has a huge opportunity to either run a marketing or advertising campaign, or to increase the ad spend that they're doing, and they know it's working, then great. And they would have to then that's where they come back to working with the CPA or the CFO to say, yes, I got approved for this alternative loan or this advance, and they feel comfortable we can pay it back. But do you feel comfortable that if I borrow $100,000 and I got to pay $10,000 a month, can I sustain that? One of the things that's, I think, unique about us, the way we do it, is that we also look at everything holistically. And that's kind of where the marketing thing comes in too, is that not like, oh, we're going to build you a website, we're going to do this. We look at it like, is there money that could be found? Because everybody's doing something to generate customers and to generate profit. And there's three, and again, as CFOs and CPAs, you could appreciate that the idea of KPIs. And so if you look at a business and you say, there's three KPIs to look at to grow a business, to find money. And that is, how many leads are you generating? What's the conversion rate of leads to sales? And then what's your lifetime value of a customer? And there's dozens of ways to increase each of those. And if you can do that a little bit, you might be able to just pull out an extra several $1,000s per month pretty immediately of cash flow. And so sometimes we'll be able to do that, coinciding the loan to help them feel like, okay, if you can help me free up the money to cover my debt service that I didn't have before, now I feel more comfortable that I'm not going to default. So they kind of go hand in hand, because the last thing we want to do is get some funding for somebody and they are scared to death every day that they can't pay it back.
So what about consolidation loans? Because that's another thing where we'll get a client that has a ton of money in AP. They have a line of credit that might be getting ready to get called. They'll have 3 or 4 debt payments. And so they're just getting stretched out in 6 different ways. Yeah. You offer the ability. I mean, again, I know it's expensive money, but if you're getting ready to get your line of credit called, vendors are coming after you. I mean, is there an opportunity there? And I mean, obviously, again, we're talking about double-digit interest rates. So is that something that you'd be able to do? And how far could they look to stretch that out? Like 24 months? Is that about as far as it gets? Or
well, let me expand on that a little bit in a different way. So we do have access to SBA lending as well, and also in a non-bank SBA capacity. So just as a general rule, SBA loan program, the parameters that are set forth by the Small Business Administration as a government entity are what they are. Every lender can then add more strict parameters. You just can't make it less strict, right? So if you take a retail bank that's offering SBA funding, it's going to be probably the most strict version of an SBA program. But SBA terms are basically the same. They're almost always 6% interest, 10-year amortization. So let's just say we're working with somebody on a short-term loan, or you or your CPAs are looking at somebody's books and saying, all right, you got all these like expensive loans, you want to consolidate, you want to drop it down. If they have improved their situation a little bit since getting those to where they have, say, 680 credit or more, and they have decent cash flow, then it might be worth it to go a non-bank SBA route like we do, because it's the most aggressive version of the SBA loan. And those ones are single digits. So if they're in that position to do that, then it's spread out from a 12-year amortization to 10-year, which is, and it's a different format. So then, you might go from the same debt amount, but going from $10,000 a month to 5, 4, 3, something like that. Now, not everybody's going to qualify for that, but it's at least worth looking at. And, it takes a while. It could take 30 to 45 days to do that, whether it's the SBA Express loans, which are 25 to 150,000. And then there's kind of this gap. And then the 7A SBA loans go from about 300,000 to usually about 5 million. And they frankly don't have a real set in stone set of parameters and projections. They kind of look at a lot of different things, and they give you approval amounts based on, your cash flow and everything. But so that is a great thing. So what happens when you do debt consolidation is you're improving cash flow. you're just improving the overall picture. And frankly, you're also driving up the value of the business, which I know a lot of you guys and your CPAs firms that work with you, they're doing a lot of work with exit planning and helping them increase their valuation before they go to sales. So there's a lot of benefits on that, and that is a great reason to do it. But outside of SBA, it's usually really not, there's no way to do it. Like, you could wrap together 3 expensive cash advances into one and then just push out your term, but you're still paying the same overall rate for the most part.
Yeah. So I'm going to jump in here real quick and throw our email address out there. So I want to make sure people have a chance to reach us, both with questions on this topic or any other podcast we've done. Or in addition, if you have an idea for a topic or want to be a guest, you can reach us at cpa@summitcpa.net. Again, cpa@summitcpa.net. So Dan, I appreciate all you've walked through here. I want to just kind of summarize and then see if there's anything else that I need to think of if I'm a CPA planning on going to you or another alternative funding. So the first tip you gave us was make sure you already go to your bank. You want to go to the bank and see if you have any funding available there. Then you talked about understanding, those 4 C's. And then I think the other key point you said is make sure it's for a reason, whether that's an emergency or an opportunity. Those are kind of the key reasons to come to you. And then obviously Adam brought up the consolidation being one of those reasons. But any other things that our listeners should know before they bring either a client to you or someone they know to you for alternative funding?
Yeah, good question. I think a lot of times, again, the first question anybody asks, whether they're a B2B company that's working with a client or the potential client themselves, is, well, what's the rate? And just know that every situation is so different. Every program is so different because, again, it might come, and if you're talking to somebody who truly takes a consultative approach to funding, then there's multiple options. And one thing I didn't mention, I'll just take 10 seconds to say it, is that, if, for example, if somebody has money in an IRA, maybe that they had a job and they started a business and it's sitting in an IRA with a normal account, you could always have that converted to a self-directed IRA, and then you can use the money for your own business. And I won't get into the details of that, but that would be an example where it's not a loan, you're not doing it in that capacity. There's other ways, and another, like a company I connected you guys with that does like commercial collections. So if they're working with a B2B company and they need capital and they have 5, 6, even 7 figures of outstanding money that's due to them, sometimes you can go to a commercial collection agency that's professional and really good at what they do, and that's another way to find money. So it's not just about debt and loans. That's kind of one of the big takeaways I want to say is, let's start with what's the need. Have you talked to your bank? Can you get what you need there? And then we can go through all these other solutions. At the end of the day, the reason we call ourselves Fully Fundable is the goal is to help the company become fundable and bankable and stable and scalable and valuable. So there's multiple different ways to look at it. And sometimes, again, it's a matter of helping them just pull money out of getting better results from their revenue generating activities. And again, as a CPA, you're probably getting hit up all the time from your clients about, what do I do for this? But you're also getting hit up with other B2B folks, maybe to get referrals as well. So I think it's always smart to look at, are they really taking a consultative approach, or are they just trying to sell your clients something in a transactional capacity? And there's a big difference.
Yeah, I think that's a great goal, and that makes a lot of sense, and it definitely makes your name make a lot more sense. That's great. Adam, any final thoughts from you before we shut down the podcast?
Yeah, my advice would just be, make sure you have somebody else in your back pocket. Reach out to the lender, make sure you know who they are, make yourself as visible as possible, and then just always make sure you have someone like Dan as your go-to whenever things aren't available or clients need extra stuff.
Awesome. Well, I appreciate you joining the show today, Dan, and really great information. So I'm sure people were rapidly taking notes as you were talking. So I appreciate you joining us.
Thanks, gentlemen. Appreciate it.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving modern CPA firm success. We're here to be a resource in this ever-changing industry.